Ever been in that spot where you're looking at a big purchase?
Yeah, like maybe a new car.
Yeah.
Or that first home.
Exactly. And suddenly you realize a seemingly random 3-digit number is, well, calling all the shots.
Uh-huh. It's your credit score.
It is. And today we're diving deep to understand just what makes it tick.
Exactly. It can feel like this, mysterious gatekeeper to so many financial opportunities.
Right.
We're going to unpack credit scores using insights from SideBySide, really aiming to demystify this crucial part of our financial lives.
Okay, so let's start at the beginning then. It wasn't always about these scores, was it? I mean, I imagine back in the day, getting a loan was a much more personal thing.
That's absolutely right. Lending used to rely heavily on personal relationships, kind of subjective judgment.
Yeah.
The shift really began back in the 1950s. You had Bill Fair and Earl Isaac.
Ah, the FICO guys.
The very ones. They developed the first, objective credit scoring system. The FICO score we basically know today.
So that brought standardization.
It did. A new level of it. And then later, much later, 2006, VantageScore popped up.
Okay, from the big credit bureaus themselves.
Right. Experian, Equifax, TransUnion.
And now it feels like your credit score is just everywhere, doesn't it?
It really does.
It's not just banks anymore, landlords, maybe potential employers, even insurance companies seem to want to peak.
We've definitely moved into a credit-driven economy. This single number, it carries, significant weight in so many parts of life.
Yeah.
So the big question for you listening is, what is this credit score exactly, and why should it really be on your radar?
Well, put simply, it's that 3-digit number, usually ranging from 300 to 850.
Right.
Lenders use it to guess, basically, how likely you are to pay back borrowed money.
Higher the score, the better you look.
Exactly. More creditworthy. And as SideBySide points out, FICO is still, the big one, used by over 90% of top lenders.
It is dominant. Though VantageScore is definitely becoming more common. You see it more often now. But what's really fascinating, I think, is just how wide its influence is. It goes way beyond just getting approved for a loan.
Oh, yeah.
Yeah, your credit score directly impacts the interest rates you'll get offered.
Right, that's huge.
Think about it. A lower score often means higher interest rates. You end up paying significantly more over the life of a loan.
Ouch.
And it plays a role in your credit card limits, too. Your ability to rent an apartment.
We mentioned landlords.
Right. And in some fields, even your job prospects or how much you pay for insurance.
That financial difference, it can be really, really eye-opening. SideBySide had that great example, Sarah and Emma.
Oh, yeah, the car loan one.
Right. So Sarah, her score was 630. She got a 7% interest rate.
Okay.
But Emma, she had a 770 score, much higher, and she got 3.5%.
Wow, half the rate.
Exactly. And over 5 years, that difference cost Sarah an extra, $2,100.
That really drives home the point, doesn't it? The real-world cost of a lower score.
It absolutely does.
So, okay, let's get into the mechanics then. How is this score actually calculated? What are the key ingredients here?
Good question. So the FICO model, the main one, looks at 5 key things, different weights for each.
Okay.
The most significant, the heavyweight, is payment history. That's 35% of your score.
35%. Wow.
It's basically just, did you pay your past bills on time?
Makes sense. Consistency.
Exactly. Late payments, accounts going into charge-off.
Which means the lender basically gave up trying to collect.
Right, they wrote it off. And debt sent to collections, those are all major red flags, big negatives.
That seems pretty intuitive. Lenders want to see you've got a good track record.
Okay, what's next?
Next up at 30% is amounts owed.
Amounts owed, okay.
Often called credit utilization. Think of it as the percentage of your total available credit that you're using right now.
Ah, right, like how much of your credit card limit you've used up.
Precisely. And the general advice, the target, is to keep that below 30% of your total limit.
Oh.
Right. Yeah, that's the benchmark you hear a lot.
Yeah.
Using too much can suggest you might be, overextended, a bit too reliant on credit.
Makes you look risky to lenders. Okay, then we have length of your credit history. That's 15%.
15%.
Yeah.
So having older accounts is generally good.
Yeah, older accounts in good standing tend to help your score, show stability.
Which is why people often say, don't close your oldest credit card if you don't have to.
Exactly. As long as it doesn't have a crazy annual fee or something.
Well, okay, what else?
Then there's new credit. That's 10%.
New credit. So applying for lots of cards at once.
Yeah, opening a bunch of new accounts in a short time can actually lower your score a bit. Lenders see it as potentially higher risk, like you're desperate for credit.
Okay, that's 10%.
And the last 10% is your credit mix.
Credit mix, like different types of loans.
Yeah, having a variety, like maybe some credit cards, an installment loan, like a car loan, perhaps a mortgage. A mix is seen as slightly better than just having one type of credit.
Interesting. So a bit of diversity helps?
Seems so. Now, it's also really important to talk about what doesn't go into your score.
Oh, good point. What's not included?
Well, your income, for one. Your job title, whether you're married or single.
Okay.
And crucially, your race or ethnicity are absolutely not factored in.
It's vital to understand. It's purely based on your credit behavior, not personal demographics like that.
Exactly. And SideBySide also notes that VantageScore, while it uses similar buckets,
Right, the other model.
it might weigh things a bit differently, maybe putting a little more emphasis on your total debt balances and your more recent credit behavior.
Ah, so maybe VantageScore reacts a bit faster to recent changes, good or bad.
Potentially, yeah. That focus on recent activity could make it more responsive.
Okay. That freelancer example, John, that SideBySide used was pretty telling.
Oh, yeah, about utilization,
Exactly. He focused on paying down his balances, got his utilization down from like 60%,
which is pretty high.
way high, down to 20% in just, what, 3 months?
Yeah, 3 months. And his score jumped from 690 up to 745.
That's a significant jump. Shows you that actively managing those balances can make a real difference, and pretty quickly, too.
It really does. It's not just about waiting years for things to improve sometimes.
So, okay, we know how it's calculated roughly, but let's talk more about the impact. We touched on loans, but how does it affect those really big life milestones, like buying a house?
Oh, yeah. Huge one. For mortgages, SideBySide mentions that lenders often look for a minimum score around, say, 620.
Okay, kind of the entry point.
Right. But, and this is key, your score massively influences the interest rate and the loan terms you actually get.
Makes sense.
Someone with a score in the 720s or higher, they're likely getting the best rates, the most favorable terms.
Okay, and someone down near that 620 mark.
They might still get approved, but maybe with a higher interest rate or maybe fewer loan options overall, it costs more.
Got it. And it's a similar story for car loans, right? You mentioned that Experian report.
Yeah, from Q1 2025, it really spelled it out. Average rate for someone with a score under 600,
Oh,
a whopping 14.5%.
14.5%. That's huge.
It is. Compare that to someone with a score over 750, their average rate was just 3.5%.
Wow. Same car, vastly different borrowing cost. It really highlights the value of a good score.
It absolutely does.
And then there are credit cards. A good score is like getting a key, isn't it?
Totally. It unlocks access to those premium rewards cards, the ones with great perks.
Better travel points, cashback.
Yeah, and higher credit limits usually, plus those attractive 0% introductory APR offers you see advertised.
Right. It's all about demonstrating you're a reliable borrower, building that trust.
It really does feel like a kind of financial VIP pass sometimes, but its reach goes even further, doesn't it? Like SideBySide mentioned employment checks.
Yes, in certain sectors, particularly things like finance, maybe national defense, security roles.
Why there?
Well, some employers might review credit reports as part of their background check. The thinking is, I guess, that a history of maybe poor financial management could be seen as a risk in jobs with big financial responsibilities or access to sensitive info.
Okay. That makes some sense.
And then the everyday stuff, like just renting an apartment,
Oh yeah, landlords definitely check.
routinely. And a lower score could mean you need a co-signer, maybe, or have to put down a much bigger security deposit.
Yeah, makes it harder to find a place.
Even your insurance premiums. Car insurance, renter's insurance in many states, they can use a credit-based insurance score, which can affect your rates.
Wow, it's really woven into so much.
That's pretty pervasive in modern life, yeah.
So, okay, for you listening right now, if your score isn't quite where you want it to be, what can you actually do? What are the practical steps?
Right. Let's get actionable. Thankfully, SideBySide lays out some really clear advice.
Okay, what's number one?
The absolute top priority, and they really stress this, is pay your bills on time. Every single time.
Sounds simple, but crucial.
It is. Set up payment reminders, use autopay if it helps, because just one late payment can seriously ding your score.
How much are we talking?
Potentially a drop of 90 to 110 points.
Oof, that's a big hit from one mistake.
It really is. So number one, pay on time. After that, focus on reducing that credit utilization we talked about.
Okay, bringing down the percentage of credit used.
Exactly. The most direct way is just, well, pay down your credit card balances.
Makes sense.
You could also try asking your credit card company for a credit limit increase.
Ah, right, because that lowers the utilization ratio if your balance stays the same.
Precisely. But just be aware, requesting an increase might trigger a hard inquiry on your report, which can slightly lower your score temporarily.
Good to know. And obviously, try not to max out your cards.
Definitely avoid that.
Okay.
Okay, what else? SideBySide also says keep your oldest accounts open.
Right, because of the length of credit history factor, don't close that old card because you don't use it much, assuming no fee.
Correct. And also, be mindful about applying for new credit too often.
Spacing out applications.
Yeah. Each application can cause a hard inquiry, lowers the score a tiny bit. Doing too many close together looks riskier. So just pace yourself.
Okay. What about people starting out or needing to rebuild?
Good question. Credit builder tools can be really helpful there. Things like secured credit cards.
Where you put down a deposit.
Exactly. Or credit builder loans, which are small loans designed specifically to help build credit history.
Okay.
Also, becoming an authorized user on someone else's credit card, someone with a good payment history, obviously that can sometimes give your score a boost too.
Interesting. Anything else?
Oh, absolutely. A really important one, check your credit reports.
From all three bureaus. Equifax, Experian, TransUnion.
Yes. You can get them free once a year at annualcreditreport.com.
And you're looking for errors.
Exactly. Mistakes happen, incorrect information, accounts you don't recognize. These can drag your score down, so you need to dispute them.
So regular checkups are key.
Definitely. Also, diversifying your credit mix might help over the long run. If you only have credit cards, maybe eventually consider a small installment loan, like for furniture or something small.
That's variety.
Right. And finally, just monitor your progress. Use those free tools like Credit Karma or apps from Experian, FICO, Wallet Hub. There are lots of options to track your score and see how you're doing.
Okay, lots of practical steps there.
And one more interesting thing, SideBySide mentioned these newer AI-powered credit building apps.
Oh, yeah? Like what?
Things like Grain, Grow Credit, Experian Boost is another one. They're trying to help people build credit by reporting non-traditional payments.
Like utility bills. Or streaming services.
Exactly. Stuff that usually doesn't count towards your score. This could be really helpful for people with thin credit files. Not much traditional credit history.
That's a really cool development. Could open doors for a lot of people.
Definitely has potential.
Now, okay, let's switch gears slightly. There are definitely some common myths floating around about credit scores, aren't there? Things people get wrong.
Oh, absolutely. Lots of misconceptions. One big one is that checking your own credit score will lower it.
Right, I hear that all the time. But it's false.
Totally false. Checking your own score is a soft inquiry. It has zero impact. It's only hard inquiries when you actually apply for new credit that can slightly affect your score.
Okay, good to clear that up. What else?
Another one, closing old credit cards helps your score.
But we just said keeping them open helps with history length.
Exactly. Closing cards can actually hurt you. It reduces your overall available credit, which can push your utilization up, and it can shorten your average credit history length. So, generally, not a good move unless there's a high fee.
Got it. Keep them open if possible. Any other myths?
Well, the idea that your income level directly affects your score.
We mentioned that's not included in the calculation.
Right. Lenders care about income when deciding if they'll lend to you and how much, but it doesn't directly factor into the score itself. The score is about how you manage debt, not how much you earn.
Okay. And what about carrying a balance on your credit card? Does that help?
The myth that you need to carry a balance month to month to build credit. Also false.
So paying it off in full every month is better.
Absolutely. It's the best strategy financially. You avoid paying interest charges, and it keeps your credit utilization low, which is good for your score. Don't pay interest just to try and game the system.
Solid advice. SideBySide also touched on some of the real challenges people face with credit, right? Beyond just misunderstanding things.
Yeah, definitely. Things like just a lack of financial education growing up. High debt-to-income ratios, making it hard to keep utilization low.
Unexpected stuff, too, like big medical bills or losing a job.
Exactly. Financial emergencies can wreak havoc. And then there's identity theft, which can obviously destroy your credit if you don't catch it.
Yeah.
And also that issue of credit invisibility.
Yeah.
People who don't use traditional banking or credit might not have enough history to even generate a score.
Which makes it hard to get started.
It creates a real hurdle, yeah. These are significant obstacles for a lot of folks.
And the system itself isn't perfect, right? There are criticisms.
True. Some argue it can favor those already wealthy. or that historical inequalities might unintentionally disadvantage certain groups. And the scores don't capture all financial behavior, like paying rent or utilities on time, though that's changing slowly.
Right, like those newer apps trying to include more data.
Exactly. And even the main scoring models are evolving. You hear about FICO 10T or Ultra FICO.
What are those?
They're newer versions trying to incorporate a wider range of data, maybe looking at savings patterns or cash flow from bank accounts to get a more, let's say, holistic picture of someone's financial health.
Interesting. So it's still evolving.
Definitely a dynamic area.
But okay, wrapping things up, the core message from SideBySide really seems clear. Your credit score, despite maybe some flaws or complexities,
It's fundamental.
yeah, it's a fundamental piece of your financial life, kind of like a silent financial resume.
That's a good way to put it. It influences so much, from loans to rentals to insurance.
But and this is the empowering part, right? It's not set in stone.
Absolutely not. That's the key takeaway. Your credit score is changeable. You can actively influence it and improve it through consistent, smart financial habits.
Totally. So the action plan for you listening is pretty straightforward, really.
Yeah.
First, know where you stand. Check your current score.
Okay.
Then understand what's influencing it, those 5 factors we talked about.
Payment history, utilization.
Right. Make a plan. Focus on paying down debt, paying everything on time. Check those credit reports regularly for errors and dispute them.
Stay informed, basically.
Exactly. Monitor your progress. It takes time, but you can make a difference.
So as we finish this deep dive, just remember, a good credit score isn't just about saving money on interest, though that's great.
No.
It's really about achieving a greater sense of financial freedom, opening up more options, more opportunities.
Financial freedom. I like that.
And maybe one last thought for you to chew on, inspired by the side-by-side guide.
Yeah.
How do things like, say, student loans and your history paying those back factor into your credit score?
Another big one for many people. Definitely something worth digging into as you continue exploring your own financial landscape.